As you all know, a few years ago, shortly before the pandemic, a massive real estate bubble burst in China. The shock was brutal, but the truth is that Xi Jinping handled it reasonably well. Some might even say he handled it almost flawlessly. He shifted money from the real estate sector to industry so that one would offset the other. That helped cushion the blow. But of course, the underlying problem still looms. Housing prices continue to plummet at a dizzying pace, and there are still some 90 million empty or unfinished apartments that aren't selling. To give you an idea of what we're talking about, housing prices have returned to levels seen 20 years ago. Or to put it another way, the decline is twice as steep as the one in the United States during the 2008 crisis. And yes, China's GDP, according to the government, continues to grow at around 5%, which is great. And meanwhile, the advances made by Chinese tech companies are mind-blowing. But be very careful, because behind all this could lie a very dark secret. The fact is, housing wasn't just another sector of the Chinese economy, it was the pillar of the entire system, the backbone of society, and not only that, but also of its finances. A situation for which we find a clear precedent: Japan. In the 1990s, a brutal financial crisis ravaged Japan for 10 years, and much of the blame also lay with an oversized real estate sector. The reason? Well, to put it very, very simply, the Japanese put all their savings into housing because, naturally, in such a small country, land and housing prices always go up. Then, the banks used these savings to grant loans to companies, which didn't usually raise capital on the stock market. So when the real estate bubble burst, everything collapsed like a giant domino, and the country entered a death spiral. With a lifetime's worth of savings evaporated and mortgages outstanding for, brace yourselves, up to 130 years, the Japanese stopped spending. It was all about saving, saving, and saving. Not surprisingly, companies were left without customers and many had to close. So what did the Japanese do when they saw this? Well, they saved even more in case the situation got worse. And so it went for 10 years of the lost decade. Well, guess what? Something very similar is happening right now in China.
A cumulative decline of 20 to 40% in housing prices may lower consumption by 2 to 4% of GDP. A property bust is more than just a sectoral problem. It attacks the principal savings vehicle for the middle class in an already low consumption economy.
According to a study by one of the world's leading economists on the Chinese real estate market, household consumption in China is more than twice as sensitive to housing prices as that of the Japanese. In other words, if the Japanese consumed 1% less for every percentage point that housing prices fell, I'm making up the numbers here, the Chinese consume 2.5% less. And I insist that the specific numbers aren't what matters. What matters is the qualitative severity of the impact. And it turns out that this is no coincidence. It's the direct consequence of the central role that housing plays in China. According to official statistics, 96% of urban households own at least one home, and 45% own at least two. And why do the Chinese invest so much in real estate? Well, take a look. You're seeing a comparison between the US and Chinese stock markets, and I think the picture speaks for itself. The Chinese stock market has been practically stagnant for 3 decades. It's not that the economy has performed poorly, the issue is that the capital markets are heavily regulated. In other words, people cannot freely invest in assets other than real estate. And here's another problem. The Chinese Communist Party has also made it practically impossible to invest in the stock markets of other countries. The exception is Hong Kong, which has gone from being the gateway for global capital into China to the exit point used by Chinese households and investors to invest in other countries. Today, 60% of the capital flowing through Hong Kong is of Chinese origin. But if households face strict restrictions on investing in the stock market and treasury bonds, and if China doesn't have a very generous pension system either, how do households save? Well, the answer is clear: in real estate. You understand now why everyone has one. The options were to keep the money under the mattress or buy a house. And hey, for decades, real estate grew as much or more than the S&P 500, so the choice was obvious. The result? Chinese households, as a whole, hold twice as much wealth in real estate as American households. $60 billion versus $30 billion. However, Americans hold stocks worth the same amount, another $30 billion, and an additional $40 billion in treasury bonds. China, by by contrast, has only $10 billion of each. Or to put it another way, Chinese households have twice as much wealth in housing as those in the US, but 3 times fewer stocks and 4 times fewer bonds. Right now, 70% of Chinese household wealth is in housing, compared to 30% in the US. In fact, China resembles Japan, but on steroids. The Japanese also have much more wealth in real estate than in stocks, but the difference is only double, not 7 times more. And besides, the Japanese offset this with more bonds. I'm sure you now understand better why the bursting of the real estate bubble has been so dramatic, and why consumer spending is in the doldrums. Now, some of you might be thinking, but Josh, unlike Japan, China's tech sector can offset the problem, right? Well, that may be true, but the exact opposite could also be the case, that the collapse of domestic consumption could hurt the industry. We'll go into detail on this shortly. But first, if you're interested in the world of investing, if you want to learn how to manage your savings, protect yourself against inflation, and figure out how to make money beyond your day job, I've got some news for you. At Visual Factory, we have created the Visual Factory Club, a newsletter where every week we send out free content focused on essential financial education, the ABC of what everyone should know to understand the stock market, financial markets in general, investment platforms, how to assess investment opportunities, and which markets may have more or less potential. Because of course, if you want to invest your money so you're not at the mercy of your country's economic instability, you at least need to understand the basics of the financial world. In the Visual Factory Club, you'll learn all of this completely free of charge. Through the link below and this QR code, you can sign up for the club and start receiving the upcoming editions. What's more, when you sign up, you'll receive a dossier where I explain, in a clear and simple way, the most essential investment concepts, what multiple or the PE ratio are, what indices are, ETFs, derivatives, funds, EPS, you get the idea. After that, every week you'll receive additional materials and market analysis to help you stay informed about what's going on. And by the way, the sooner you sign up, the better. Since we send each episode of the series by email, and every edition is unique, if you're not subscribed, you might miss some of them and you won't be able to access them later. That said, let's continue with China. Well, China's problem lies not only in its savings, but also in its productive economy. You see, during the bubble years that led China into its lost decade, construction accounted for 6% of GDP. But in China, here you can see a comparison. At the end of the 20th century, real estate accounted for 2% of GDP, but in just over a decade, it increased 5-fold. But after the bubble burst, it began to fall. And watch out, because it's still falling. And given this decline, it's no surprise that consumption has been stagnant for years. And this is what leads us to the other sectors. Because yes, in recent years there's been a lot of talk about China's technological marvels, such as BYD's electric cars. Even so, while exports have skyrocketed thanks to all these cutting-edge products, the number of cars sold annually within the country has been stagnant. Wait for it. Since 2018. Ironically, Chinese companies have revolutionized the automotive market in every country in the world, except China. Well, actually, fewer gasoline-powered vehicles and more electric ones are being sold, but the total number of cars is indeed stagnant, even though the car ownership rate remains quite low. All of this, moreover, is linked to another trend that is becoming increasingly concerning: the gig economy. You know, very low productivity jobs in the service sector, like delivery riders and the like. And the thing is, let's be honest, normally poor countries like India have a sky-high self-employment rate. This isn't because everyone has a huge entrepreneurial spirit. No. For the most part, we're talking about people who can't find jobs and so make a living however they can. And as countries get richer, the norm is for all these people to gradually join the regular labour market, thereby reducing the rate of self-employed workers. However, in China, the opposite is true. In 2000, the percentage of self-employed workers was between 5 and 10%. Today, nearly 1 in 3 workers is self-employed. And again, we're not talking about successful entrepreneurs or owners of a nice restaurant. Yeah, fine, but what does all this have to do with housing? Well, a lot. When the bubble burst, Xi Jinping ordered the banking system to shift all real estate credit toward industry. But not just any industry, specifically highly automated, high-tech industries. The results? Well, it may surprise many of you, but since 2011, China has lost 7.5 million workers in the manufacturing industry, and the percentage of workers in this sector is also falling. Yes, we said since 2011, long before the bubble burst, because housing isn't the only cause, but it has certainly accelerated this process, with one additional point. In Japan, banks took money from mortgages, lent it to companies, and well, we all know how that ended. And something very similar has happened in China. The same play, but with different actors. Instead of banks, the lenders have been local governments. And instead of ordinary companies, the loans went to zombie companies, infrastructure projects, and yes, also to construction firms that built more houses to generate more credit, and so the wheel kept turning. Furthermore, these loans have historically been very opaque. When the Chinese government set out to bring them to light in late 2024, they discovered that local government debt was about 3 times higher than it appeared at first glance. Today, many of these zombie companies and construction projects are going bankrupt, driving up employment. What's more, local governments have lost their main source of revenue to pay off these debts, and if they try to pay them off by raising taxes further, they risk hurting the economy. In short, we're seeing a two-pronged attack on household consumption. On the one hand, these households had invested all their savings in assets that have been falling by more than 10% annually for several years. And worst of all, they're still falling, with no sign of stabilizing anytime soon. But on the other hand, real estate was a very significant part of the economy, both directly and indirectly. Now that it has fallen, unemployment is on the rise and new jobs are somewhat more precarious, so households have less money to spend. All of this is very similar to what happened in Japan. That said, there are two main differences, one that works in China's favor and another against it. In favour of the idea that there won't be a crisis as severe as Japan's lost decade, we have the fact that the banking system is much more isolated and protected from the housing market. Yes, it's true that housing, as such, is a more significant part of the economy than it was in Japan, but remember, the main debtors have been local governments and developers, such as the famous Evergrande, not the banks. Yet there is another key difference from Japan that could deepen a crisis: demographics. When Japan stagnated, it was already a very wealthy country. We all know what happened next. Caught between the slowdown caused by the real estate crisis and the demographic crisis, Japan stopped growing. And these days, even Spain has a higher GDP per capita. China, on the other hand, is a much poorer country that is also aging very rapidly. To give you an idea, China today has the same ratio of workers to people over 65 that Japan had when it was about 3 times richer. And why is this important? Well, first, because an aging population is very damaging to the economy, since workers have to pay more taxes to support them. But there's another more subtle detail, and perhaps a more important one. China, despite all its progress, remains a developing country. Only 6% of Chinese people, those living in Tier 1 cities like Shanghai, have incomes comparable to Japan's. Note, this is the average for all of Japan, don't just think of Tokyo. In contrast, the most populous cities, the Tier 3 ones, are on par with Mexico or Thailand, though there are also many people living in Tier 4 cities, with an economy comparable to Vietnam's. And clearly, as in any developing country, China lacks a large public assistance network or a massive welfare state. That has its advantages, yes. Yes, we've already seen what happens when countries go too far with these matters, but in the face of a crisis, without that safety net, households typically save as much as they can, just in case. And we're back to the same issue as before: more saving, that is, less consumption. In the short term, hurts businesses, increases unemployment, the economy suffers even more, and the cycle starts over again. What's more, as if that weren't enough, the demographic pyramid cannot sustain housing prices in the long term either. It's true that China still has a large rural population that could move to the city, increasing housing demand and stemming the fall in prices. However, the data is not very optimistic. In 2020, 1/3 of all Chinese cities lost population. And we're not talking about a few small towns in the countryside, no. This pattern is seen across the country, and most importantly, in cities of all sizes, including some with populations of over 10 million. In conclusion, China exhibits many of the same symptoms Japan did after its real estate bubble burst. Housing prices are following the same pattern, falling very rapidly even now, half a decade after the Chinese boom. In fact, we could say that the situation is even worse. Housing is a much more significant part of the economy in China than in Japan, both as a percentage of GDP and as a percentage of household savings. And, as was to be expected, since the bubble burst, consumption has been practically stagnant. GDP is growing, yes, but it owes it all to exports. Exports that aren't boosting domestic consumption among the Chinese, and that aren't a panacea for GDP either. Remember that before the crash, China's GDP was growing between 6 and 7% annually, and now it hovers between 4.5 and 5%. In a sense, China's GDP continues to grow because it's a poor country and still has a long way to go. But there's no doubt that it's now moving along that path more slowly. Does this mean that China is going to experience 30 years of economic stagnation stagnation like Japan? Well, no, but it does run the risk of GDP slowing down. And in a poor country that is aging so rapidly, that could indeed be fatal. In any case, now that we've reached this point, it's your turn. Did you know that housing prices are still falling in China? Do you think this could be the start of a longer crisis, or is it actually a good thing that prices are getting lower and lower? Will China manage to avoid a lost decade like its neighbours to the east? You can leave your answers down in the comments. And if you want to understand what's really happening in the markets and learn how to manage your money with more confidence, join the Visual Factory Club. It's completely free and the link is in the description. As always, don't forget that here on VisualEconomik we release new videos every week, so subscribe to this channel and click the bell icon so you don't miss any of our updates. If you like this video, hit like and see you in the next one. Take care, I'll see you next time.